picture this scenario. You're a founder, right? You have just spent 6 grueling months negotiating a $25 million Series A round.
Oh, a huge milestone.
Exactly. The term sheets are signed, the champagne is literally chilling on ice in the break room, and your entire team is just exhausted but ecstatic.
Yeah, that's the dream.
But then, the lead investor's legal team calls. An auditor found a single missing piece of paper, just one form that you forgot to mail to the IRS
Right.
3 years ago when you were working out of a garage.
Right.
And just like that, because of that one missing piece of paper, your valuation drops by 20%. $2.5 million of your life's work just vaporized.
It is a devastating phone call to receive. And, unfortunately, it happens far more often than anyone in the venture capital world likes to admit publicly.
I mean, startup culture has this famous, almost sacred mantra, right? Move fast and break things. It's heavily glorified in those earliest days of building a company.
Oh, absolutely. It's the whole ethos.
You're supposed to break old paradigms, break inefficient workflows, break the status quo, but nobody tells you what happens when the thing you accidentally break is international tax law.
Yeah, because as it turns out, the regulatory authorities in Germany or the IRS here in the U.S., they do not care how disruptive your new software platform is.
No, not at all.
They don't care in the slightest. Government tax authorities are not nearly as forgiving as your early seed investors. They operate on rigid codes. I mean, not visionary potential.
Welcome to today's deep dive. We are talking directly to you, whether you're actively building a startup, maybe evaluating companies to invest in, or if you're just sort of endlessly curious about the hidden mechanics of how businesses actually scale behind the scenes.
It's such an important topic.
And it really is. Our mission today is clear. We are exploring this transition from early-stage startup chaos to mid-stage operational maturity. Right. We want to equip you with the foresight to avoid the invisible, silent tripwires that can entirely derail a company's valuation.
The premise of this white paper fundamentally challenges how we think about risk. The authors argue that the most dangerous threats to a growing company aren't the loud ones like a competitor launching a clone product or a server crashing.
The stuff you normally worry about.
Exactly. The existential threats are the ones quietly sitting on the books, accumulating interest and massive penalties entirely out of sight.
Okay, let's unpack this. The core thesis of the paper is that a startup's internal operating system often remains dangerously frozen in its scrappy, pre-revenue mindset, even as the company itself scales rapidly in the real world.
Right.
To understand how these silent tripwires are triggered, we have to map out the predictable, 3-stage life cycle of a startup's compliance journey. I know the authors segment this by revenue, right?
Yes, they break it down into 3 distinct phases. So you have 0 to 1 million, 1 to 10 million, and 10 to 100 million.
Okay.
And the behavior that gets rewarded in that first stage perfectly sets a trap for the second. In the 0 to 1 million stage, absolute chaos is entirely tolerated.
Because speed is the only metric that matters at that point.
Yeah.
You have no real revenue, maybe some informal payments via an app, completely undocumented equity promises made over coffee, verbal agreements with contractors.
Yeah.
Compliance is consciously deferred because founders think, well, if we don't build the product people want, none of this legal stuff matters anyway. And you can usually get away with it because you haven't crossed any meaningful regulatory thresholds yet.
You don't have substantial assets to protect, and you haven't triggered the rules of the larger economic game because, well, you barely have a game going.
Right? Right.
But if you jump ahead to the third stage, the $10 to $100 million phase, the picture completely changes. Scale brings intense scrutiny. You have a full-time CFO, you have external auditors, regulators are paying attention.
We have a real company now.
Exactly. If you make a mistake here, the penalties surface loudly and immediately. You get hit with a highly visible back tax bill, or diligence red flags block a major M&A deal. The reckoning is very public.
But the real danger zone, the part of the journey we are zooming in on today, is the murky middle, that $1 to $10 million stage. The paper calls this the blind spot.
It's such an accurate term.
It is. Operating a $1 to $10 million startup is like driving a high-speed car without a dashboard.
Cool.
You literally do not realize you're speeding. There's no speedometer needle creeping into the red. You just keep driving, feeling great about your velocity, until a stack of incredibly expensive tickets arrives in the mail 3 weeks later.
What's fascinating here is how the white paper defines this specific maturity gap. It is not a knowledge problem, it is a timing problem.
Oh, interesting.
This is a crucial distinction to grasp. It's not that founders are oblivious to the fact that corporate taxes or labor laws exist. The issue is a massive temporal lag, which the paper calculates as a 12 to 36-month delay between the action and the consequence.
Wait, meaning I can drive past the speed camera today, the flash goes off, but I don't find out my license has been suspended until a year or even 3 years later.
Yes.
Why is the lag so incredibly long?
It comes down to the natural audit cycles of massive bureaucracies. Violations are incurred in real time by the startup, but government agencies do not audit small companies in real time.
Ah,
So a founder might cross a critical regulatory threshold in the second quarter of their first year, but they might not receive their very first automated inquiry letter from a tax authority until the third quarter of their second or third year.
wow.
And during that entire blind period, the financial liability isn't static. It is silently compounding with interest and failure to file penalties. The business is scaling fast, but the governance model hasn't updated since the garage days.
Let's get into the specifics of what actually triggers those cameras. The white paper outlines 6 specific invisible landmines founders step on during this lag period. Let's dig into these tripwires, starting with one that honestly stopped me in my tracks: phantom permanent establishment, or phantom PE.
Phantom PE is a classic example of this blind spot in action. Let's construct a scenario. Imagine a standard US-based tech startup incorporated as a Delaware C Corp.
Pretty standard.
Very standard. They start getting some organic user traction in Europe. So, to capitalize on that, they hire their first dedicated sales employee based in Germany to run the European market.
Hold on, let me stop you there to play devil's advocate. If I am the founder of that Delaware C Corp, I pay my corporate taxes to the IRS in the United States. Why would Germany have any right to tax my corporate entity just because I hired one remote sales guy who happens to sit in Munich? Like, that doesn't make intuitive sense.
It doesn't make sense until you view it through the lens of international tax treaties, which focus on where value is actually being created.
Value creation.
Yep, right. The German tax authorities look at that remote worker and ask, is this person habitually conducting business and closing contracts on behalf of a foreign entity on our soil? The moment the answer is yes, that Delaware C Corp has inadvertently pierced the corporate veil. They have created a permanent establishment in Germany.
A taxable corporate presence created entirely by accident.
Yes. Suddenly, your U.S. company is subject to local corporate tax in Germany on a portion of its profits. You have local filing obligations, payroll compliance issues, and severe audit risk.
Jeez.
And it's called a phantom PE because it exists purely on paper in the host country's tax system long before the startup's founders have any idea they've triggered it.
So by the time it actually surfaces, which the paper notes usually happens during a Series B audit or when you try to get acquired, the company's sitting on 2 or 3 years of unremitted corporate tax exposure in a foreign country. That is a ticking time bomb.
It is, and that leads directly into the second major failure pattern, which is the VAT cliff and state nexus. This is all about crossing invisible revenue thresholds completely undetected.
Right, the revenue traps.
In the European Union, value-added tax, or VAT, registration becomes legally mandatory the moment your cross-border sales to EU consumers exceed 10,000 euros.
10,000 euros. For a software company growing at 20% month over month, you cross that threshold in your sleep. I mean, that's a rounding error for a scaling business.
It is. And the moment you cross it, every single invoice you issue to a European customer without a valid VAT number is technically non-compliant. Customers can sometimes even seek to void those invoices during contract renewals because the paperwork is legally invalid.
Oh, wow, they can just cancel the contract.
Exactly. And the U.S. equivalent is arguably even more insidious.
You're talking about the Wayfair decision.
Yes, the 2018 Supreme Court ruling in South Dakota v. Wayfair. Before that ruling, a state could generally only tax a business if it had a physical presence there, like a warehouse, an office, or employees.
Which makes sense.
It did. But Wayfair changed the game by establishing economic nexus. Now, states can tax you based purely on your digital footprint and sales volume in their state. And the thresholds are astonishingly low. It is typically $100,000 in sales or just 200 separate transactions.
Wait, let me do the math on that. 200 transactions. If you are selling a $50 a month subscription, you hit 200 transactions before you even have enough revenue to hire your first engineer.
Easily.
You trigger tax obligations in states like Texas, New York, or California. And there is absolutely no internal alarm bell on your dashboard that rings to warn you.
None. The liability just stacks up. You owe the uncollected sales tax out of your own margin plus penalties.
So VAT and Nexus are about crossing revenue thresholds. You get penalized for making money in a new place. But it's the third pattern in this paper, which is getting heavily penalized when you have literally zero revenue.
Ah, yes.
Let's talk about reporting accumulation, specifically Form 5472.
Is an information return required by the IRS for foreign-owned U.S. entities. So if you are a non-U.S. founder who incorporated a Delaware company to access American venture capital, you must file this specific form every single year.
And here's the kicker. They have to file it even if there are zero transactions, right? Even if the company is just a dormant sitting there while they build a prototype.
Even with zero transactions, because it is an information return, the IRS is penalizing the failure to disclose the structure. If a 1 to 10 million stage startup just doesn't know about this obscure form and misses the deadline.
They probably will.
Right. It carries an invisible penalty balance that starts at $25,000 per year per unfiled form.
$25,000 vanishing into thin air every single year just because you didn't file a piece of paper reporting that nothing happened.
Yep.
And speaking of paperwork, the fourth and fifth patterns revolve around cleaning up your own internal house, right? Equity documentation gaps and the 83B election window.
Equity gaps are very common. As a team scales from 3 founders to 30 employees, you start handing out equity to attract talent. It becomes a routine part of the hiring process.
Naturally.
But if those routine grants lack proper cap table governance, meaning you don't have the formal board resolutions documented, or the vesting terms are vaguely written in an email, it creates a massive, tangled legal web.
I can see how that gets messy. But I have to jump in here on the 83B election, because to me, this is the absolute peak of the blind spot. The risk-to-effort ratio is almost comical. Explain how this works, because it sounds like a trap designed specifically to ruin a founder's life.
It essentially is a trap for the uninformed. If you receive restricted stock in a U.S. entity, which almost all founders do when they incorporate, you have exactly a 30-day window from the date of the grant to file an 83B election with the IRS.
Okay, let's use concrete numbers to explain the mechanic here. Let's say we start a company today. I issue myself 1 million shares. On day 1, those shares are practically worthless, maybe valued at a penny each.
Yes. If you file the 83B election, you are telling the IRS, I want to be taxed on the value of these shares today, right now. Since they are worth a penny, your tax burden is essentially zero.
And it's literally just a single-page letter. I print it out, I mail it to the IRS. But what happens if I forget? The 30-day window closes, and my shares start vesting over the next 4 years.
If you miss that 30-day window, there is no cure. You cannot retroactively fix it. And the mechanic flips. Instead of being taxed at grant, you get taxed as the shares vest. Let's say in year 3, your company is doing great, and those shares are now valued at $10 each as they vest. The IRS will view that appreciation as ordinary income. You will be taxed on $10 million of phantom gain out of pocket, even though you haven't sold a single share and your company hasn't gone public.
Millions of dollars in excess taxes, potentially bankrupting a founder, all because of a single-page letter that had to be mailed within 30 days.
It perfectly synthesizes the entire blind spot. This raises an important question: why do founders miss this? The issue with the 83B election, and really with all 6 of these failure patterns, is never a lack of urgency or a lack of care.
Right, they aren't lazy.
No, if a founder knew it would cost them millions of dollars in year 3, they would drive to the post office and overnight the letter themselves. The issue is a complete lack of awareness. They just don't know the window is closing until it's already shut.
So we have these hidden liabilities accumulating. Phantom PE in Europe, state sales tax nexus triggered by a few hundred subscriptions, missing $25,000 IRS forms, undocumented equity promises, and blown 83B elections.
It's a lot.
It is. The liability is silently building up behind the scenes. But eventually the dashboard lights up, the tickets arrive in the mail, and the white paper mats exactly when that happens, the Series A reckoning.
This is the inflection point. The reckoning arrives when institutional investors step in to lead a Series A funding round. They bring their legal teams, and they run structured, aggressive compliance audits as a mandatory condition of closing the round.
They're digging deep.
They aren't just trusting your visionary pitch deck, right? They are lifting up the floorboards to see what is rotting underneath, and what they find directly destroys the value the founders have spent years building.
The hard data in this report is genuinely grim. What actually happens in that boardroom when the lawyers find the missing forms and the foreign tax exposure?
There are 3 primary consequences. First are direct valuation cuts. Unresolved compliance exposure reduces enterprise value, essentially dollar for dollar. The paper cites a standard 10 to 20% reduction.
Wow.
So in your opening scenario, a hard-won $25 million valuation is instantly devalued by $2.5 to $5 million just to account for the risk. Your hard-earned equity vaporized at the finish line.
And even if you manage to defend the valuation, you still face the second consequence, right? Severe delays and escrow holdbacks. Investors will routinely force a 60 to 120-day delay on the funding wire, forcing the founder to pause product development and spend 2 months cleaning up historical tax messes before they see a single dollar.
Exactly. Or, in acquisition scenarios, the buyer will hold the purchase funds in escrow for up to 36 months post-close to ensure no old tax bills pop up and surprise them.
And then there is the third outcome, the kill shot. The paper documents that in 29% of cases, a startup loses a deal entirely.
29%.
The investors just walk away. The
Yeah.
deal dies simply because a crucial compliance certification was missing, and the risk was deemed too high to inherit. So, what does this all mean for you?
It's the critical question.
If you're listening to this and building a company, think about where your energy goes on a daily basis. Founders spend 99% of their time pitching the upside of their business, the total addressable market, the amazing product roadmap, the visionary disruption. But they completely neglect protecting the downside. By ignoring the boring back-end mechanics, you are essentially handing sophisticated investors a legitimate, documented reason to discount your life's work.
If the consequences of this blind spot are so devastating, it begs the question of survival. How does a lean $1 to $10 million startup actually protect itself? They're fundamentally a small team. They cannot afford to hire an expensive, enterprise-grade internal legal and compliance department.
Exactly my thought. You can't just hire a $250,000 chief compliance officer when you're still trying to figure out your core product market fit. A 15-person team is focused on survival, not corporate governance.
The authors of the paper argue that a startup doesn't need a massive department. It needs systems. 5 specific systems, to be exact. And the framework relies on a vital philosophy for early-stage companies. Calendar discipline beats legal sophistication every single time.
I love that phrasing. Calendar discipline over legal sophistication. Meaning, you don't need a law degree to survive, you just need to know when the deadlines are. How do these 5 systems actually operate in a real startup environment?
First is entity and equity documentation. You must keep all grants documented in real time, keep board minutes current, ensure the cap table is perfectly clean, and most importantly, file those 83B elections within the 30-day window.
Got it.
Second is tax trigger monitoring. You need a live register tracking exactly where you earn revenue, where you hire remote people, and where you hold physical inventory, constantly checking those footprints against permanent establishment and VAT thresholds.
Okay, I'm going to push back here. A live register of international tax triggers sounds great in a white paper, but how does a CEO who is also acting as the head of product and the lead sales rep actually build and monitor that without going entirely crazy?
If they do it manually, they will go crazy, which is why the third system is a centralized reporting calendar. This is a single source of truth for all annual reporting obligations, with automatic, non-dismissible reminders set 90 days before each deadline.
It's okay, that makes more sense.
The fourth system is transfer pricing foundations. If you have multiple entities crossing borders, you need formal intercompany agreements with arm's-length pricing documentation to satisfy local tax authorities. And fifth, and this is perhaps the operational linchpin, a named compliance owner.
Meaning it can't just be someone's job or we'll figure it out in Q4.
It absolutely cannot be the outsourced accountant we only talked to in April. It has to be a specific, named, proactive owner responsible for executing that calendar, whether that person is internal or a dedicated external partner.
Here's where it gets really interesting, though. Even with a calendar, managing those 5 systems manually sounds like a massive headache that pulls focus away from building the product.
Right.
Merze positions itself as the ultimate operational solution for this exact stage of a company's life. They call themselves the AWS for U.S. tax compliance. And honestly, considering the sheer complexity of what we've just discussed, that analogy tracks perfectly for
It's a very apt comparison.
Think about it. 10 years ago, a founder might have bought physical servers, racked them in a closet, and managed their own cooling systems just to host their website. Today, that's unthinkable. You just spin up Amazon Web Services. So why on earth would a modern founder try to manually manage international tax triggers and state nexus thresholds in a Google Sheet?
They shouldn't. It is an inefficient use of founder capital and time. And that is exactly the problem Merze is offering their cross-border U.S. tax intelligence system is built to solve. It is important to note this is not just a basic software tool that files a generic return once a year.
Right, it's more comprehensive.
It is an end-to-end expert infrastructure. They are essentially offloading this entire function. They get a fully functional finance team equipped with CFO-level expertise and highly qualified CPAs who specialize in U.S. and cross-border mechanics.
So it's bridging that massive expertise gap immediately, without the founder having to become a tax scholar.
It bridges the expertise gap, and it bridges the geographical gap. They provide access to registered agents across all 50 U.S. states, ensuring you maintain good standing everywhere your digital footprint might accidentally trigger that Wayfair nexus.
Nice.
And the execution of those 5 systems we discussed becomes entirely automated. Everything from tracking those pesky Form 5472s that carry the $25,000 penalties to managing standard 1099s for contractors is handled with zero manual effort from the founder.
And because this is all tied directly to surviving the Series A reckoning we talked about, it solves the diligence panic.
Yeah, it proactively eliminates the panic. Because Merze maintains GAAP-compliant bookkeeping continuously in the background, the startup is effectively export-ready for investor due diligence at any given second.
That's huge.
There is no 120-day scramble to clean up the historical books because the books are inherently clean from day one. They have proven this model out extensively. The paper notes their track record. They have executed over 2,000 completed filings for more than 500 founders, maintaining a zero-churn record.
Zero churn. Wow.
The value proposition is as simple as it gets. Deploy the infrastructure once and scale your business automatically without looking over your shoulder.
Stop thinking about international tax law and start building your product. That is a massive operational unlock. So let's bring this all together. We've journeyed from the tolerated beautiful chaos of the 0 to 1 stage, where moving fast and breaking things is the only law of the land. But then we entered the silent, dangerous territory of the $1 to $10 million blind spot. This is where invisible thresholds like Phantom PE, the European VAT cliff, and U.S. state nexus are crossed without a single alarm going off. Where unfiled Form 5472s and missed 30-day windows for 83B elections quietly stack up millions of dollars in hidden liabilities.
Liabilities that remain entirely hidden from the founders.
Until the exact moment you can least afford those tickets to arrive the Series A due diligence process. The moment where institutional investors will slash 20% off your valuation, delay your critical funding for months, or in 29% of cases, just walk away from the deal entirely because the underlying foundation is too messy. But by recognizing this timeline today and implementing an automated compliance infrastructure, whether through incredibly rigid internal calendar discipline or by plugging into an expert system, you arrive at the negotiating table bulletproof. Whether you are building a business, evaluating one for investment, or just studying the game, understanding this invisible timeline is a massive competitive advantage. You get to keep your dashboard clean, even while you are speeding up.
If we connect this to the bigger picture, it leaves us with a fascinating dynamic to consider moving forward. Historically, venture capitalists have somewhat expected early-stage startups to have messy books.
Yeah, totally.
It was seen as a rite of passage, a standard growing pain you fix after the Series A. But if platforms like Merze's are making compliance binary, affordable, and fully automated from day one, that historical grace period for early-stage mistakes might vanish entirely.
That's a good point.
In the very near future, will investors stop viewing these compliance gaps as mere growing pains and instead start viewing them as a fundamental red flag of a founder's overall operational incompetence? If the solution to protecting your downside is as easy as plugging into an expert infrastructure, failing to do so might tell an investor everything they need to know about how you run a business.
That is a thought for any founder still trying to run their back office on a spreadsheet. We hope this gave you some serious food for thought and a detailed map to navigate the blind spots in your own ventures. Thank you so much for joining us, and keep questioning the hidden mechanics behind the businesses you interact with every day.